the problem about central banks and about conventional macroeconomic theory in general is that it doesn't ask how we got here. I said Greenspan was great at saying, where are we? What's happening? But the important thing is to understand how we got here and why we got here. And that's just simply never done.
Hello and welcome to this IEA Book Club event with Bernard Conolly. I'm Daniel Freeman, I'm a Research Assistant here at the IEA. Before we turn to our panellist, we just have a few housekeeping points. First off, due to GDPR, I'm obliged to tell you that we are filming this event. The camera will be focused on the stage, but during the Q&A, your voice and question will be recorded, so just be aware of that. We'll begin with the proceedings tonight with a discussion between me and Bernard. This should last about 20 minutes, and after this we will have a Q&A session to give you the chance to ask questions to our speaker. I would like to ask all of you to turn off your mobile phones or set them to aeroplane mode. I'll give you a few moments to do that. If you need to use the lavatories, there is a women's toilet out of that door on your left and down the stairs. It's immediately on your left, and there is a men's toilet through that door and on your right. It should be difficult to miss it. As you will have noticed on coming here, we are having some building works, so that means that our garden is out of action. If you are desperate for fresh air or to smoke, you'll have to go out through the front door. So with that out of the way, I'm delighted to introduce tonight's guest speaker, Bernard Conolly. Bernard is an economist formerly employed by the European Commission and is the author of the international best-selling book on monetary matters, The Rotten Heart of Europe. A consultant and wealth manager, he is highly respected by central bankers, policymakers and financial market participants, and has published innumerable articles in both the financial and general press. Bernard, thank you for being here. So today we are going to be talking about Bernard's new book, You Always Hurt the One You Love, which, despite the title, is not a romantic novel. It is something far more interesting, thought-provoking and substantial. This is an account of 30 years of failure on the part of central bankers and how, in the author's view, this is threatening the very foundations and sustainability of capitalism. So, first off, what made you decide to write this book now?
Well, really, I'd been writing it for 25 years, as the clients of the financial market firms that I used to work for, and then my own firm, would know. And I in the 80s and early 90s, my main focus had been on Europe. When I was ejected from the European Commission, I had to broaden my compass and became very, very interested in the US economy, and in particular US monetary policy. At a time when US firms had regained a lead in cutting-edge technologies. Remember, in the 80s, everyone thought Japan was the big thing. And there was an atmosphere of very considerable optimism about the US economy. Not in the first half of the 90s, but by the time we got to the mid-90s, there was a lot going on in the US economy. There was the potential for a big wave of investment, And subsequently, and that's an important word in this context, subsequently an improvement in productivity. Now, 10 years before that, I think in 1988, I had written a paper about Nigel Lawson's response to a somewhat similar, there were differences, but somewhat similar period of optimism in the British economy as a result of the Thatcherite reforms. It's quite hard to remember now, but I think there were 60,000 new companies created in Britain in 1988. In both cases, very clever men and very ardent capitalists, Nigel Lawson in the British case and Alan Greenspan in the American case, misunderstood the demand-side implications of supply-side improvement. And by that I mean that they failed to realise that if you have a burst of innovation in a particular segment of the economy, call it tech as a shorthand in the US case, if you have that burst of innovation, because there's a massively increased prospective rate of return on capital in those firms. Now, if there are enough of them for that increase in the rate of return in those firms to have an impact on the economy-wide projected rate of return on capital, then what should happen is that the real interest rate goes up to match that. And if it doesn't, and it didn't in either case, first in Britain in the mid-80s, and then in the United States in the mid-1990s, or it didn't go up enough or soon enough, you have an imbalance in the time structure of production and demand. Let's say if you have this burst of innovation, which, in order to be translated into increased productivity, has to go through investment. Now, there may be some general purpose technologies, there may be some disembodied investment, but generally speaking, when there's a burst of innovation of that kind, there has to be innovation, there has to be investment to transform the technological advance into productivity improvement. Now, when investment is being done, it requires resources. It adds to aggregate demand without increasing aggregate supply. When it has been done, the investment stops. You
get a shift in aggregate goes supply.
Up, so you have unless the interest rate coordinates saving and investment decisions correctly, you have an initial period of overheating, followed by a period of deficient demand. And that's exactly what we saw
with the dot-com bubble.
With the dot-com bubble. You mentioned the bubble. Now, the bubble is another thing that one has to think about very carefully. The bubble arose initially because the rate of interest did not go up as much as the expected rate of return on capital. So the discounted value of future earnings goes up. However, once a mania begins, and I think it did, I was often in New York at the end of the 90s, and you couldn't go into a restaurant or a cafe without people telling you how much their portfolios have gone up in the past week. Once you get that mania, it is very difficult to restrain it. Now, the conventional way of looking at bubbles is to say, well, monetary policy has only very blunt instruments. The interest rate is too blunt an instrument to deal with a bubble once it has begun. Now, that may be true. If you jack interest rates up when the bubble is well advanced, you're going to burst it and you're going to get recessions and all sorts of things. What one should do is prevent the bubble in the first place by making sure that interest rates go up. As soon as the central bank can see the signs of an incipient, where it can see the technological innovation, it can see the burst of investment. And Alan Greenspan, piquantly, was one of the very few people in the American economy who did spot that. He was very, very good at looking at the details of economic data and discerning what was happening. What he wasn't so good at was understanding why it was happening and what the consequences of those events were going to be. And rather than taking the view that, oh yes, if we don't raise interest rates now, we're going to dislocate the time structure of production and demand over the next few years, he took the view that, oh good, productivity is going to go up.
So that will solve the problem, we'll all be more productive.
We don't need interest rates. It would be more productive, it would be easier to cope with inflation. We can have lower interest rates without stimulating inflation.
Yeah.
I'm sorry, but once things have gone wrong, as they went wrong, the dot-com bubble burst at the beginning of 2000, American firms suddenly realized that they had a lot of new capacity. And where was the demand going to come from? Consumption had not been held back by higher interest rates, or not
so there wasn't savings that could then be thrown into...
There was no pent-up demand left.
Yeah.
When the initial burst of investment petered out, there was nothing to take its place. Other areas of investment had not been held back. They'd been stimulated, in fact, by the combination of sub-equilibrium interest rates and a great deal of optimism. Consumption hadn't been held back. There was a hole in demand. It took the Fed a while to realise that, but eventually, by the beginning of 2001, they were cutting interest rates very hard. And cutting interest rates very hard, the Fed funds rate ultimately got down to, I think, 0.5% or 1% in 2004. Simply recreates
the same problem. But instead of tech, where does the money go into after that point?
Well, it goes into financial assets, and that's what we saw. And it goes into housing, and that's what we saw. There's a tremendous housing bubble in the United States from about 2002 or 3 until the peak was probably the end of 2006. And that housing bubble was associated with a credit bubble. Where were people getting the money to pay these inflated house prices? They were borrowing it. And we're all, of course, familiar with the term subprime borrowing, and that was just, if you like, the tip of the iceberg of a massive superstructure of credit, of new credit instruments, of credit derivatives, wholly dependent on the maintenance of low interest rates.
But surely in this case, if certain central bankers at least were able to perceive this problem even in the late 90s, but were able to explain it away by saying, oh, well, you're throwing lots of investment into tech, but that's going to boost productivity. So that, even if you think it's misguided, that's at least an explanation. Why wouldn't they take more measures earlier with a housing bubble where it's not obviously going to lead to increased productivity in the future?
Because they denied that there could be a housing bubble.
Right.
I mean, even the most enlightened and sensible of central bankers, Mervyn King, for instance, who was a great central banker,
who recommends the book,
yes,
as it happens,
took the view that house prices reflected the future stream of housing services. And the Bank of England took the view that a house price explosion would not add significantly to demand. And in a sense, they were right. It adds to demand only if there is a bubble. And if you don't think there's a bubble, then there's no problem. And as where the stock market bubble was concerned, the standard view of central bankers and academic economists at the time, as I mentioned before, that you can't really do anything about it. And Ben Bernanke, who was Greenspan's successor, insisted frequently that if we raise interest rates, you won't be able, all you do is reduce investment. And no amount of increase, and I say no amount of increase in interest rates will deter investment in the bubbly, in what he called the bubbly sectors. But it shouldn't. I mean, what you want is interest rates not, if the firms with very strong investment opportunities often had 20, 30, 40% prospective returns. Now, if the interest rate goes up from 5% to 6%, that doesn't make any difference to them. But you don't want it to. You want that increase in from 5% to 6% or whatever it is to hold back, to postpone investment in those sectors where the rate of return hasn't rocketed. Postpone it until the burst of investment in the high-tech sector or whatever has subsided, has subsided, increased supply, and then there's something to fill the gap that's left by that sudden stop in high-tech investment. And that, I think the problem about central banks and about conventional macroeconomic theory in general is that it doesn't ask how we got here. I said, Greenspan was great at saying, where are we? What's happening? But the important thing is to understand how we got here and why we got here. And that's just simply never done.
Well, that's a really interesting point, because how much of this reluctance to put up interest rates in the 2000s and, well, even over the last 10 years before the recent burst of inflation, how much of this is essentially, how much of this is a difference in economic perspective? They think it's actually fine. And how much is it essentially political? That if we increase interest rates and then the economy starts to tank, we get blamed. And also, how are we going to justify this if inflation is sort of chugging along at 2-ish%, as it was through much of the 2000s?
Or even falling below 2%.
Yeah.
The problem that the central banks perceived was for a long time that they couldn't get the inflation rate up to their target of 2%. There's always a bit of politics in everything, but I think that was most evident in leading up to the presidential election in '98 in the US, where the administration was taking the view in 96, 97, there's a bubble, the sooner it's burst the better, we can get things back on track again before the election. Well, that didn't happen by the time we got into '98. Oh my goodness, it's far too late now, we can't do anything, we've got to let it rip. But the main thing was I think a failure of the academic macroeconomics industry. I think it's better to call it an industry than a profession. Didn't understand how capitalism worked. It didn't understand what is capital. Marxists would say it's stored up labour. What I think one should regard capital as being is stored up future productive potential. Financial markets, the rate of interest, trade, if you like, the perceptions of the past and the present against expectations of the future. Well, that first part of the triplet the past is important and is typically disregarded in mainstream macroeconomics, largely because to an extent, the mathematization of economics has been a good thing. It's imposed a degree of rigor. But what it's done is oversimplify the way of looking at economics. If standard theories, well, so-called dynamic stochastic general equilibrium theory, basically assumes that there are shocks to the economy which are inexplicable, unpredictable, unforecastable, and policy has to react to them. But these shocks are statistically well behaved. They have a mean of 0, they're IID and independently distributed independent variables. Once the shock has subsided, you just go back to everything's fine again. You go back to normal. And that is clearly not the case, because what we've seen is that the response of monetary policy to shocks has set in motion an unstable equilibrium, which has been getting worse and worse and worse. And it's still getting worse. I mean, things have changed over the past 3 or 4 years, and perhaps we'll come on to that. But there is a failure of almost of willpower in the economics profession, that we don't want to upset the apple cart. We have to rethink everything if we acknowledge that we can't just look at where we are today, but we have to look at where we were yesterday and 10 years ago and how we got from there to today. That's what capitalism is about. It's about that progression from the past to the present to the future, and that's simply not taken account of
properly
sufficiently.
Addressed, yes. So you brought up sort of the issue with shocks, and certainly over the last 3 years we've had quite a few of them. Obviously, inflation today is a far greater political issue than it has been for over 30 years in most of the Western world. In your view, what's the main driving force behind the most recent sort of surge of inflation?
Well, of course, there was a shock. There was a series of negative supply shocks. COVID, the lockdowns and their catastrophic effects, the Ukraine war. We're all familiar with the series of shocks that's hit. And those shocks were negative shocks to potential output. If you maintain demand in the face of a downturn in productive potential, you're going to get inflation, and that's part of the story. Another part of the story is the way in which that attempt to maintain demand was done. You know, I think given lockdown, or the first lockdowns at any rate, it would have been very difficult for governments not to try to replace the incomes of the people who were told
so through the furlough scheme, for example.
But initially, you know, one thought one was told this is going to last for 3 weeks. It didn't last for 3 weeks. It went on, in effect, for about, the furlough scheme didn't, but the lockdowns went on for a couple of years. There were very substantial government deficits. Now, if the central banks, as they did, or governments took the view that interest rates were going to remain negative in real terms, as they had been before COVID, then you just basically don't worry about that additional spending and borrowing. Even if you think that interest rates, real rates, are going up to, I don't know, whatever they were in the 19th century, let's say 2.5%, as long as the government deficit came back down when the lockdowns ended, it wasn't a catastrophic event in public finance terms. But what we've seen, and both here and even more worrying, I think, in the United States, is that there's been a succession of massive government deficits, not related anymore to COVID and lockdown, deficits that seem as though they're going to go on effectively for forever. I'll come back to in a moment, to what that does to the way that central banks look at the world. But the third element was that central banks looked back at the period from 2008 to 2000, whenever it was, 20, and said there were negative interest rates,
and we didn't get inflation.
And we had massive quantitative expansion, and we didn't get inflation. And they failed to recognise that the quantitative expansion, the very low interest rates, the asset price bubbles, which were revived from about 2013 onwards, were necessary to prevent recession because of the underlying intertemporal disequilibrium that I tried to sketch. And in those circumstances, if you've got to keep printing money in order to avoid a recession, by definition it's not going to cause inflation. In the very different circumstances of the past 2 or 3 years,
where you have fiscal expansion combined with monetary expansion, combined with supply shocks.
Fiscal expansion, a supply shock. If you pour money into the economy, if you have substantial money printing, to use that phrase, you're going to get inflation. Part of the problem was that the central banks, governments, in 2020 were worried, and they were quite right to worry initially, there might be a Keynesian recession as a result of COVID and lockdowns. Because a Keynesian recession was staved off by things like the furlough schemes, one could characterise that series of events as something like a weekend. You know, if you think during the week people are producing, the weekend they go out to pubs and restaurants and they're not working and they spend. I mean, some people do, we know, but in general, you get output Monday to Friday, spending Saturday and Sunday. Now, no one worries about the fact that output goes down at the weekend. Because you know it's going to go back up again on Monday.
But if you end up having almost 2 years of weekend,
exactly,
it causes problems.
If you have 2 years of weekends, it causes problems. But it also misleads central banks into thinking that you know, we heard, even still we hear people talking about the Great Recession of 2020. It wasn't. It was like an extended weekend. And central banks don't print money, don't cut interest rates because there are weekends. And they didn't realise that the right way to look at what happened in 2020 was as a sort of extended weekend, rather than an incipient, well, it was an incipient Keynesian recession, but it's very quickly staved off. And they still continue to think about it in those terms. And the combination of supply shocks, the fiscal spending, the massive monetary expansion was inevitably going to create inflation, and has done.
So what should they have done differently if you had been appointed as the governor of the Bank of England with dictatorial policy powers over monetary policy in 2020, say? What would your approach have been?
Well, I think in March 2020, I'd have cut interest rates, as I think the bank did. But as soon as it became apparent that there was not going to be a Keynesian recession, and that took a bit longer to become apparent in Britain than it did in the United States, because there was a bit of a more miserable atmosphere and the lockdowns were harsher and went on for longer. But certainly by the end of 2020, the Bank of England should have realised that it was by then something like an extended weekend rather than a Keynesian recession.
Mm-hmm.
You didn't need additional monetary stimulus in those circumstances. They should have taken back the interest rate cut. They certainly should not have engaged in the massive QE in which they did engage.
Well, one of the interesting things I read recently in an economic affairs article, which is the IEA's economics journal, but a piece by William Buter, the Dutch-American economist, was he pointed out that the Fed's QE program, bond buying, was still going until March 2022.
Yes.
A lot when it was very clear that COVID was no longer a major issue.
Well, I think there's partly that no one likes admitting to mistakes, and you hope that something will turn up and get you out of it. Yeah. And the central banks did not admit to mistakes. I think the Bank of England never has. In the States, in addition, there was an additional factor that the Fed had become, woke in a word, in that if you look back at what Powell was saying in his press conferences in 20 and 21 and 22, he always prefaced his presentation with a paragraph about the impact on minorities and low-income workers.
Mm-hmm. Do you think that actually was dictating their policy makings, or was it just window
it may
dressing?
have been an excuse. I don't know. But it certainly had an impact. Whether they really thought, they did think that we have to run the economy at very low rates of unemployment if we're going to be inclusive. Because the only way we can get the unemployment rate for blacks and other minority ethnic groups down to acceptable levels is if we push down the overall unemployment rate to very low levels.
Right.
And they believed at the time that the Phillips curve was very flat, that inflation hardly responded to variations in the level of unemployment. So they weren't taking a risk in that, and they were furthering their social objectives in trying to push the unemployment rate down sufficiently to improve the labour market for blacks and so on.
Right, I see. So, dealing with the kind of final chapter in this book, which is helpfully titled "What Needs to Be Done," you come up with sort of two solutions to the overall broader mess that we've got ourselves into. The first you call recapitalismization, which is a bit of a mouthful, but I think it gets the idea across.
Yeah.
And the second one, we'll deal in a moment. But could you explain what you mean by recapitalismization?
Yeah, what it means essentially is that there have to be measures which will increase the prospective rate of return on capital, such that the real rate of interest can rise to consistency with the rate of time preference, which the rate of time preference determines the very long run equilibrium real rate of interest, and do that without crushing the economy. You've got to get the rate of return. In a sense, it's validating ex post the expectations that have been falsely built into current asset prices. And how do you do that? Well, you don't do it by increasing the rate of return on capital in existing firms by regulatory capture or rent seeking. There's a huge amount of rent seeking in Western economies at present. Markets have been rigged to the advantage of large firms. The most important market of all, trading between the past, the present, and the future, the interest rate is of course rigged by central banks. Maybe it has to be. You don't do it through handing more to Jeff Bezos or whatever. What you have to do is stimulate additional increases in productivity through radical deregulation and tax cuts.
Right.
Now, that sounds like a very sort of right-wing program.
Well, yeah, isn't this just... Didn't we try that with Truss?
We talked about it. It didn't actually happen. I mean, the interesting thing about Truss is that the financial market reaction was exactly what the economy needed. Higher interest rates and a weaker currency. Now, typically one thinks of higher interest rates as being associated with a stronger currency. If there's a loss of confidence, or one might put it differently, saying there's an outbreak of realism about future prospects, then exactly what you need is a higher interest rate to hold back consumption, right? A weaker exchange rate to stimulate exports, so that the holding back of domestic demand doesn't create a recession. But that's
but it didn't seem to be politically feasible, even if in the abstract.
I'm not saying that anything like that was ever in the minds of Liz Truss or Kwasi Kwarteng.
No,
but
that's a fair amount that wasn't in their minds.
Well, we tried it. We didn't try it. I think everyone agrees that in terms of public relations or political calculation, it was a very cack-handed attempt at improving things. However, it may have been in fundamental terms. But what you have to do, if this apparently very right-wing programme is going to have any chance of acceptability...
This where we come on to your point two.
You have to couple it with a reduction in the rents made available to large firms, and you have to do something about what I've called the unacceptable element of wealth, or perhaps illusory is a better word. What I mean by unacceptable or illusory wealth is wealth accruing to person X, which, if it was spent, would reduce consumption for everyone else.
Could you give me an example of where that might be the case today?
Well, a bit less now than 6 months or a year ago, but housing wealth, stock market wealth, asset price wealth in general. Now, if everyone who owns stocks and shares said, oh great, I'm wealthy, I'm going to spend this you don't have to be like Marcus Rashford and pull out a 600,000 Rolls Royce when you crashed a £700,000 Rolls Royce the day before, but I'm going to spend my stock market wealth. What does it get spent on? Where are the resources? Where is the output?
So it just leads to inflation.
It just leads to inflation.
Right.
And it impoverishes everyone else.
People who don't have this inflated asset.
As I mentioned, Jeff Bezos, he's an extremely rich man, but there is an argument to be said that, well, what he did actually substantially increase consumption possibilities for everyone else.
So how do we deal with this unacceptable wealth, as you call it?
Well, the idea I put forward in the book is that there should be a substantial tax.
A wealth tax?
No, not a wealth tax. A tax on unrealised capital gains, and that's very different. A wealth tax, a tax on genuine wealth, would be destructive of innovation, of enterprise. It would be wholly pernicious. What I'm suggesting is that there should be a tax on the, what you might call the bubble element of unrealised gains.
How do we determine what's
Well, you
which
can do
part
it-
of this asset is bubble and which part is real.
Well, you can do it in a rough and ready way, but no rougher or readier than the way in which any tax is assumed. By attempting to establish when there was an intertemporal equilibrium in the economy. And I suggested in the book that was 1995 in the United States and 1997, coincidentally or not, in Britain. And you can look at the PE ratio. And firms who have done very well, who have contributed to genuine wealth, will have PE ratios that are above the average. If you try to say, well, what is an equilibrium level of the PE ratio? Once you've established that or attempted to establish that, you can look at today's PE ratios, and if the adjusted for inflation and GDP growth, where the E takes account of that, and you can impose a tax on the excess.
So
Now,
the increase in the value over time.
The increase in the value that is not related to
economic growth.
To economic growth and future productive potential. No,
Right.
that's rough and ready, and you don't. I mean, you won't. I said 95 in the United States, 97 in Britain. Anyone who bought shares in 2021, the calculation of any possible excess capital gains tax for them would take into account obviously the starting price, which is already very, very much higher than it had been in 1997. So you're not going to penalise people retrospectively, so to speak. Now, there are all sorts of problems with that. And first of all, the idea that the PE ratio can be, an appropriate PE ratio can be calculated, depends on identifying a period in which there was intertemporal equilibrium. You know, I can have a go at that, but people can disagree. It depends on when I talk about the PE ratio for the economy, effectively that's GDP to overall profits. There are all sorts of accounting issues involved in that. It's very difficult to establish PE ratios for closely held business assets, for artworks, whatever. You probably couldn't do it.
This would apply to real estate as well.
It would. And that's politically difficult. There's no doubt about that.
Especially as would this not affect pension funds and things like that?
Yes. Well, no, because what I've suggested is a sort of safeguard mechanism where the taxable unrealised gain would have to be more than
$5 million. I think you suggest.
So almost everyone would be untouched, which is in a sense the idea that the inequality of wealth can be treated to an extent by having a tax on unrealised bubble gains above a certain limit.
And what's to stop, just on a sort of final point on this, what's to stop you make it very clear that this is a sort of one-off windfall event, essentially. What's to stop a left-wing government coming back in 5 years' time and saying, well, this, we've had lots of other distortions since then, so very conveniently we also want to have another raid on unacceptable wealth?
Well, I mean, the one-off nature of it in a sense solves that problem. Is you're looking back, you're calculating a PE ratio, you're taxing that excess, it's true, there's nothing to stop a government coming in 2 years' time and saying, well, the previous government imposed, 40% tax on that. We'll have the other 60% or whatever, or some portion of that. What this proposal attempts to do is to set out a program, as I've called it in this ugly phrase, recapitalismization, that would eliminate bubble gains. You'd be raising the prospective rate of return on investment to allow the real interest rate to go up to be consistent with the rate of return preference. If you do that, you don't need bubbles anymore.
Right.
You see, at the moment, we've needed bubbles to, not over the past 2 years, we've had the opposite problem, but we're going to go back to needing bubbles to prevent recession.
Right.
If you want to get out of that, you've got to do something. Now, I don't imagine that this would be easy. To be frank, I don't imagine it's at all going to happen. But one has to have, one has to think about what is needed. And for us, my bosses in the European Commission always used to say, il faut lancer l'idée. That's what I'm trying to do, to get people to think about how we've got into this situation. And a very narrow
route out of it. Yeah, well, I think it's undoubtedly true that this book definitely has elements that are very thought-provoking for people on the free market economic liberals, even if not all of us agree with every element of it. I think I'm going to move now to Q&A. So we have a roving microphone. If you'd like a question, can you put your hand up? Can we choose the guy at the end? Yes.
Thank you. Thank you very much for the talk. It was very interesting. I kept thinking about, well, you were mentioning the different areas in which rates don't match expected returns. What's your view? And also, if you know about it, what is the central bankers in general view on the very elemental idea that the same that we don't need and we don't want, and it would be horrible to have someone deciding what the price of wood should be, because nobody would know and it would distort everything. Why do we need and why do we want someone to decide what the price of money is, which is way more complicated and has consistently failed for the last 100 years?
Well, the alternative is...
Thank you.
Free banking, I suppose. And it's not at all clear that the behaviour, the success of a free banking system would be greater than that of central banks. The basic problem, I'm sure you know, the basic problem is asymmetric information. And Charles Goodhart, 30 years ago, wrote a book about why do we need central banks, and it does come down to asymmetric information. And if you think about the financial crisis we've had, and particularly the 2007-2008, that was very much a problem of asymmetric information, but asymmetric information in the private banking system, or specifically the shadow banking system. I know something about that because I was working for a firm that was at the very epicenter of the financial crisis at the time. There has been really from the late 19th century a sort of social contract that says depositors have to be protected. And for depositors to be protected, without a central bank, you have to have something like 100% reserve ratios for banks. which is an idea that's been put forward by very eminent and very respected economists. The combination of the politics and the economic dislocation of a major change in the system in that direction, I think, is would be likely to lead to a new period of financial crisis. Again, if we were starting from a tabula rasa, you might not want to have the system we have today with central banks. But starting from where we are, I think it's just too dangerous to try to abolish them. Now, you can do things to central banks and the banking system in general to try to make it safer, and we've seen a whole host of initiatives from various international bodies over the past 15 years to try to increase the safety of the banking system. But all those measures neglect the fact that the underlying reason for the problems has been this intertemporal disequilibrium because central banks have got interest rates wrong. And that is just a horrible, horrible state of affairs. I have to say, I'm frankly very, very pessimistic about the future of our economies, about the future of financial systems, about the future of democracy. Starting from here, we're in a mess. I don't, I've put forward a suggestion, which I have very few hopes of seeing even discussed, never mind implemented. But I'm basically extremely pessimistic about the future. I'm sorry to have to say that.
Yeah, it certainly comes across in the book.
Yeah.
As it happens. Well, another question over on this side, please.
Thank you. The corollary of your suggestion on taxing of bubble gains away is that when the bubbles burst, that money should be given back to the investor who suffer losses. Now that will happen at precisely the time when there's likely to be a recession and when sovereign governments will be under real pressure on their fiscal balances. And they'll go bust at that point if they have to give the money back. And they will have to give the money back if we're going to be fair.
No,
what's the solution to this?
I don't think they have to give the money back to be fair. The gains have not been associated with increases in productive potential. The programme as a whole would involve raising the rate of return to allow the rate of interest to go up without crashing asset prices or the economy. Now that may be hopelessly optimistic, but that's the intention. Just, so to speak, to validate ex post the asset prices which currently exist. Now, it may be that set of measures to increase the rate of return, to increase the rate of interest, will change the distribution of wealth as it is today. Now, so much the better if that's what it does. The idea about taxing unrealised gains is just a sort of almost a throwaway to say, look, what can we do to try to not make it look as though this programme of recapitalisation is just a right-wing ramp. Now, may not work, probably won't work, but I don't think that it causes a series of problems which would ultimately end up in government failure. By the way, I should say that one of the big worries I have at the moment, particularly in the United States, where there's a full employment deficit of 6% of GDP, is that the basic arithmetic of that suggests that if you're going to stabilise the debt, you've got to have highly negative real interest rates. and it's bad for everyone. And that really does worry me. And how is the central bank going to be politically forced into operating those negative real interest rates? I think it might well be. We are at risk of seeing, as you know, it's called fiscal dominance in the literature, and that's a big worry.
Mm. Okay, I believe we had a question at the back.
Hello, thank you for the talk, very interesting. Given the title of your book, I was expecting far more central bank bashing, frankly. But very simple question, do you think that the Bank of England should remain independent?
The short answer is I don't know, and let me try to explain why I don't know. I've thought for a long time that the combination of central bank independence and inflation targeting was going to have unacceptable political results, because it means that the central bank essentially is determining the distribution of wealth in the economy, and it shouldn't be doing that. It doesn't have a democratic mandate to do that, and that's something I think which is objectionable. But again, from where we are now, with we've had significant inflation, there is a risk of fiscal dominance, that eliminating central bank independence will make that fiscal dominance a reality very quickly. And we would have very substantial and extremely damaging and corrosive inflation. So, maybe 4 years ago, I would have said central bank independence has become objectionable. Now, we may have to put up with it as a defence against fiscal irresponsibility. Having said that, we all have to realise that we don't live in democracies anymore. That we're run by a clerisy of bureaucrats, quangocrats, charities who are unaccountable and often quite gleefully anti-democratic, to the extent that hardly seems to matter what the government thinks, as the clerisy has got its own idea. The central banks, by and large, you say you're expecting more central bank bashing in the book. There isn't. In fact, I have a lot of kind things to say about a lot of individual central bankers. I think that compared with, I don't know, what, the BBC or the National Trust or the various regulatory agencies and so on, the central banks are pretty decent people. That's maybe because I just know more of those than I do of the regulators and the quangocrats. That's another example of saying that if we were starting with a clean sheet, we could do things differently. We're not starting with a clean sheet, and there's always a set of serious political questions of trade-offs. I remember Harry Johnson, who is a very great economist of the sort of 50s and 60s, talking about the theory of the second best. I think he said, if I can get this right, the problem with second best solutions is that they are derived by second best economists, implemented by third best bureaucrats, and approved by fourth best politicians. And we haven't got the first best. What do we do? It is always going to be messy. And the choice you make has to depend on the circumstances of the time. And so I think I have changed my own view on this particular subject over the past 3 or 4 years.
Yeah. Okay, I think we have time for one last question. we have someone at the back in glasses.
We're both gesturing at each other.
Oh, okay then. Sorry, I didn't see them.
We can take multiple questions in one go.
Oh, okay. Then you two, and we have one man at the front. Please keep them very, very brief.
Okay, I'm Bruno Pryor. I'm one of the trustees here, and my day job is in renewables, but not that kind of renewables that are cheap and there when you want it. I'm more comfortable with your diagnosis and your prescriptions. This is a question more about the diagnosis, to be friendly. The dominant factor in our industry, of course, is net zero. And even before net zero, policy environment was much the same. It's driven by the need to get quite ridiculous amounts of hardware deployed, trillions of dollars of investment, and policy is always aimed at what they call de-risking. Now, I absolutely agree with you about the need to get the interest rate up. How will they be able to square net zero with a program to invest trillions of dollars that is only viable at negative real rates?
Okay. Next question. So we'll take three in a go and then.
Yeah, thank you. Sorry, that was very, very incredibly interesting idea. So thank you for bringing that across. I was going to ask a little bit more about the first half, the recapitalizationism of the program, and a little bit more detail on what that would involve. How do you meaningfully raise the real rate of returns? If we could snap our fingers and do this, surely we would have done so.
Okay. And one final question with this gentleman at the front.
Thank you, Bernard. Very interesting. I mean, it seems the Bank of England can't forecast their way out of a paper bag. In your experience of the private sector, is there a better way, or is the future just unforecastable?
Okay, excellent. So three questions: net zero and its effects, more details on recapitalisation, and why are the Bank of England so bad at forecasting?
Well, it can't be, on the first question, it can't be done without negative real interest rates, and negative real interest rates mean persistent inflation. And that is something we should all be worried about. So the second question was?
On recapitalismation. Oh, yes, I'm struggling here.
I think the first thing to do is to restore democracy by reducing the power of the quangos, the regulatory agencies, and so on. It involves restoring education in schools and universities, which education has been replaced with woke indoctrination. It involves substantial deregulation, and one could say it involves taking advantages of the opportunities that were presented by Brexit, which haven't been taken advantage of. It involves reducing taxes on enterprise, initiative, work, the opposite of a wealth tax, because initiative, enterprise, work create wealth, genuine wealth. Now, if we could click our fingers, would it happen? Well, a lot of people don't want it to happen, first of all, because there is a huge amount of rent seeking in Western economies. And that's part of the reason I say we have to do something about the power of the, whatever you want to call it, the clerisy, the blob, the establishment, which is about comforting the power, the perks and the privileges of the clients of these organisations.
And
Is it going to happen?
who knows?
And
The final question
are
on
private sector forecasters any better?
Yeah.
Not much, because there's a set of incentives in private forecasts, basically the investment banks and the brokerage houses and so on. And there is always maybe an unconscious bias towards optimism. You want people to buy the stocks and shares, you want people to invest in companies. Having said that, if you look at interest rates, the market, if you compare market forecasts for interest rates with the famous dot plot that the Fed produces every couple of months, by and large, the market has been better at forecasting interest rates than the organisation that sets interest rates. A major problem with, I come back to this quote, this dreadful DSGE, which one mustn't confuse with DGSE, which is a very different kettle of fish altogether. Dynamic stochastic general equilibrium. There was an academic article a few years ago by a lady who's now the assistant director of the Division of Monetary Affairs in the Fed, and a Turkish academic, who said that the lack of forecasting ability of DSGE models is exactly what one wants to see, because we assume that all shocks are unpredictable, inexplicable. If we could forecast them, there'd be something wrong with our model.
Wow.
So we have to get it wrong.
Well, on that note, I hope you're all sufficiently demoralised. We'll have to call the evening to an end. I just have to thank a certain list of people. First off, the IEA donors who keep the lights on and pay for our wine. The second group are the IEA Book Club members. If you're not already a Book Club member, feel free to speak to Delino, the guy at the back with the pink tie, and he'll be happy to sign you up, which gives you various preferential access to various events. Just to let you know, Bernard will be doing a book signing at the back, and if you haven't bought a copy of the book already, you are free to purchase one from the stall over there. Other than that, just to let you know, the bar remains open till 7:30, so feel free to help yourself to whatever from there. And my final person to thank is Bernard Conolly, both for writing the book and giving us such an interesting
Thank you.
interview.
Thank you. I've enjoyed
Yes.
it. Thanks.
Yeah. So.